Hello, it's ChewDog Charts. Now, do you remember back to the year 2000? And then do you remember the Dirty Dozen stocks? Well, at the time, the Dirty Dozen stocks made up a massive market cap inflation and then the collapse. The Dirty Dozen included Microsoft, Cisco, Dell, Intel, GE, Yahoo, AIG, and Juniper Networks, plus four others that didn't make it, which were Lucent, WorldCom, Global Crossing, and Nortel. Together, they represented a classic blow-off top. When the bubble was nearing its peak in early 2000, the $3.8 trillion of market cap represented by these 12 stocks was capturing most of the oxygen left in the room. And if you remember, the buying frenzy at that time had narrowed more and more to a smaller and smaller group of names. These were the momentum stocks of their time. Today, we have something very similar, and we'll call them the Delirious Dozen. So let's take a look. The concentration of market value of these stocks wasn't evident during the period of time when Greenspan made his December 1996 irrational exuberance speech, and then in April 2000 when he told the Senate that no bubble was detectable. Subsequently, the group of 12 stocks combined market cap soared from $600 billion to $3.8 trillion. That represented a virtually impossible 75% annual growth rate, for which was already mega cap stocks. Subsequently, and in fact, $2.7 trillion, or about 71% of the group's bubble peak market cap vanished after the peak in early 2000. Further, the value of these 12 stocks never came back. And the market cap of the 8 surviving companies, all of which continue to grow, today stands at about $1.3 trillion, or about 34% of the 17-year-ago peak. And that's primarily because the market caps no longer afford the mind-boggling valuation multiples. The 8 surviving companies posted a combined net income of $52.3 billion during the period of time up to September 2017, well beyond the tech bubble. And the current earnings reflect a 25 times multiple and not the 70 times multiple recorded way back then. So now we've identified a new roster we'll call the Delirious Dozen of 2017. And so the new Delirious Dozen consists of the FANG stocks, which are Facebook, Apple, Amazon, Netflix, and Google, plus 7 other high flyers, including Tesla, Nvidia, Salesforce, Alibaba, United Health, Home Depot, and Broadcom. Their combined market cap has soared from $1.7 trillion to $4 trillion during the last 40 months, reminiscent of the increase for the dot-com companies back in 2000. So that's an increase of $2.23 trillion. Thus, Amazon is now valued at $550 billion and trades at 293 times its net income. But most of that net income is attributed to its rent-to-cloud service. Broadcom trades at 246 times net income, and Netflix is valued at 194 times net income. If we remember, Cisco had a 200 times multiple back then and now trades at 19 times. Or Intel had a 60 times multiple back then and a 16 times multiple today. And now let's focus on Salesforce, which is currently valued at $77 billion, and Tesla, which has a market cap of $54 billion. Yet both had large net losses during the last 12 months. In fact, during the last 5 years, Salesforce has posted cumulative net losses of $650 million, and Tesla has lost $3.3 billion. So even if these two companies do avoid the fate of, say, Nortel and Global Crossing, earnings are going to be a miracle. Another miracle is that Alibaba has a 55 times multiple, Nvidia has a 50 multiple, and Google and Facebook, each at 35 times, are essentially defying the math. Google and Facebook also may be the greatest things since sliced bread, but they are virtually 100% dependent upon advertising revenue. And during the last recession, global ad revenue plunged. As this chart shows, the annual change in ad revenue plunged from 2006 down into 2009, both around the world and in the U.S. Subsequent to the 2009 plunge, it did bounce back into 2010, but subsequently has moved sideways, while at the same time, the market value of Google and Facebook have both increased significantly. It just doesn't appear sustainable. So of the Delirious Dozen stocks for 2017, only Apple has a reasonable multiple of about 19 times. However, Apple has been cycling along the flat line with regard to revenue and earnings. Its revenue has been hovering around $230 billion per year, and earnings have flatlined at about $50 billion per year. And it seems to be difficult to increase substantially the revenue or the earnings, while at the same time the market cap of Apple has increased dramatically. The overall market cap for the Delirious Dozen has tripled to $3.2 trillion, while its net income has climbed to $65 billion. This indicates a multiple of about 49 times, which is not likely to be sustainable. So, in my opinion, other than maybe Apple, the Delirious Dozen of 2017 are set up for a repeat of the dot-com crash. So for now, that's ChewDog Charts. Thank you.